All right, let's dive into this explainer. Today, we're taking a really close, structured look at an absolute titan in the global luxury space, Compagnie Financière Richemont SA. Now, the corporate name might not ring a bell right away, but you definitely know their crown jewels. We're talking about legendary brands like Cartier, Van Cleef & Arpels, and IWC Schaffhausen. So let's set the stage here. We are looking at an absolute behemoth with a market capitalization of roughly 113 billion Swiss francs, commanding a global workforce of over 39,600 employees. That is massive. But behind all the glitz and glamour of the luxury sector, what is the true financial health of this empire as of August 2026? Well, we're going to decode the numbers, unpack their strategy, and frankly, look at the structural risks to figure exactly that out.
So, here's our quick roadmap for today. We'll cover 1. The Richemont luxury empire. 2. Record-breaking financial growth. 3. Why analysts are bullish. 4. Corporate shifts and restructuring. 5. The bear case and risks. And finally, 6. Our final verdict and outlook. We'll objectively weigh those dazzling numbers against the actual structural risks.
Section 1. The Richemont Luxury Empire.
Okay, to really grasp the financials, we first have to understand the sheer scale of Richemont's playground, right? Like, what is actually bringing in the cash? When you break down the revenue, it is crystal clear. Jewelry is the undisputed king here. A staggering 74% of their net sales comes directly from their Jewellery Maisons. This huge slice of the pie is driven by powerhouse industry-dominating brands. Think Cartier, literally the world's #1 jeweler, alongside Van Cleef & Arpels, Buccellati, and Vernier. Then you've got specialist watchmakers, legendary names like Piaget, Ailong and Sonnet, and Jaeger-LeCoultre, pulling in 14%. And the remaining 12%? That's your fashion and accessories, brands like Montblanc and Chloe. So while they do have a hugely diversified global footprint, with the US bringing in 22% of sales, China at 18%, and Japan at 10%, when it comes down to the products, they are heavily anchored in high jewelry.
Section 2. Record-breaking financial growth.
So exactly how much cash is rolling in? Well, their financial momentum at the end of fiscal year 2026 was just extraordinary. Net profit jumped 27% to 3.48 billion euros. And they are sitting on a 9.1 billion euro fortress of a balance sheet. But the real spark, the thing that really caught the market's attention, came on July 15, 2026. First quarter group sales hit a staggering 6.33 billion euros. To put that into perspective, we're talking about a 20% jump at constant exchange rates. And those Jewellery Maisons we just talked about, they surged by 24% alone, marking their 7th consecutive quarter of double-digit growth. That is wild.
And this perfectly illustrates why those numbers turned so many heads on Wall Street. You've got the actual Q1 sales of 6.33 billion euros, just completely towering over the analyst forecast, which was pegged at only 5.90 billion euros. So this wasn't just a minor beat, It was a massive outperformance. It was broad-based too, across divisions, across geographies, and across sales channels, which basically proved that their momentum was way stronger than anyone anticipated.
Section 3. Why analysts are bullish. Given that massive earnings beat and that fortress balance sheet we just mentioned, it's absolutely no surprise that institutional experts are heavily leaning into the bull case right now. Out of 26 polled analysts, there's an overwhelming buy consensus on the stock. The average 12-month target sits at 212.30 Swiss francs. That implies a very healthy 9.5% upside from recent levels. Across the board, from Morgan Stanley to JP Morgan, RBC, Deutsche Bank, the ratings are green. Notice Bernstein at the top there. Led by analyst Luca Solca, they've actually identified Richemont as their absolute top preference in the luxury goods sector for 2026. They reiterated a really aggressive price target of 240 Swiss francs, primarily because they just love the company's unshakable position in jewelry and their incredibly disciplined capital allocation.
Morgan Stanley completely echoed this enthusiasm. They literally called the recent quarter one of its strongest performances on record. So why all this overwhelming optimism? Well, it boils down to a few key things. First off, high jewelry is proving to be incredibly resilient, especially right now as other fashion segments are starting to stumble. Secondly, Morgan Stanley pointed out a really encouraging metric. Spending by Chinese nationals actually turned positive in Q1, after being totally flat the quarter before. And finally, analysts are projecting positive upward revisions to EBIT estimates for the first time in about 18 months. That's a real game changer.
Section 4. Corporate shifts and restructuring.
Now, running a 113 billion franc empire isn't just about sitting back and counting record profits. It requires constant corporate maneuvering.
This timeline gives us a clear look at their strategy of rationalization and optimization. Let's walk through it. Back in January 2026, Richemont announced they were selling the Swiss watchmaker Baume Mercier to the Damiani Group. This was a highly strategic move to trim the fat, basically focusing entirely on their core juggernauts like Cartier and Jaeger-LeCoultre. Fast forward to August 2026, and we saw some standard corporate governance disclosures about management insider trades executed between the 10th and the 12th. But the big news? That dropped just a day ago on August 21st, 2026. IWC Schaffhausen confirmed structural job cuts. This affected 18 positions out of their 800-person headquarters. The brand stated this was simply to adjust their organizational structure to evolving business needs. But honestly, it shows that management is willing to make surgical cuts, even when they're pulling in record revenue.
Section 5. The bear case and risks.
But look, every empire has its shadows, right? Despite having a pristine balance sheet and that beautiful 9.1 billion euro cash pile we talked about, there are several macroeconomic headwinds looming large. Investors absolutely have to be aware of these. The most glaring tension right now is basically a tale of two markets. On one hand, you have booming demand in the West and Japan. The Americas are up 27% and Japan is up an incredible 36%. But contrast that with the China wildcard. Remember, China accounts for 18% of Richemont's total sales. Bank of America has explicitly warned that the luxury sector needs improved trends in China to make any sustainable recovery to historical levels possible. And right now, visibility for a sustainable recovery in that market remains very low. So we're looking at a massive concentration risk here.
And really, this China uncertainty is just one of several compounding risks. Let's break down the bear case a bit more. Beyond China, you've got a stretched valuation. Richemont is trading at roughly 35 times trailing earnings. Deutsche Bank actually warned that this premium leaves little room for error, meaning any further upside is going to require fresh upward earnings revisions. Then add in elevated gold prices, which are definitely starting to weigh on margins. On top of that, you have broader geopolitical tensions making investors kind of skittish. And finally, there's the looming long-term threat of local Chinese luxury brands, which are increasingly stepping up to compete directly with these Western houses.
Section 6. Final verdict and outlook.
So let's bring all of this together. We've seen the jaw-dropping jewelry growth and that pristine balance sheet, but we've also weighed the stretched valuation and those macroeconomic shadows. Richemont clearly represents a highly durable, top-tier franchise in a very resilient sector. I mean, the jewelry category has proven time and again that it can weather economic cycles. But at these valuations, the market is practically pricing in perfection. So if you're tracking this space, the ultimate test for these conflicting forces is just around the corner. The next major catalyst is their earnings report, which is expected on November 13th, 2026. Mark your calendars, because that will be the moment of truth to see if this incredible upward momentum can actually be sustained.
Which leaves us with one final thought to ponder. Richemont is absolutely firing on all cylinders today, but the global economic landscape is shifting rapidly beneath our feet. Will the sheer dominance of legacy brands like Cartier outshine the mounting pressures of global wealth shifts, those expensive valuations, and a highly unpredictable Chinese market? Definitely keep an eye on that November 13th date. Thank you so much for joining us for this explainer, and we'll see how the glitz holds up against the economic grit.